Hello everyone. For this video I will briefly go over Chapter 8 and also a reminder that the midterm will be coming up. I'll probably post it this weekend and it'll be due sometime next week, and this will cover Chapters 1 through 8. So if anybody has any questions, please let me know beforehand. So Chapter 8 is why do financial crises occur and why are they so damaging to the economy? So another fairly short chapter where really there's no quantitative problems. So there are terms in here that are in the slides that you should know. I'm not going to just read those verbatim to you. I don't think that's very useful. So I'll just quickly go over what a financial crisis is and how it happens, and then I will do my best to explain how the 2008 financial crisis, the housing crisis, happened. Although I am not an expert, but I'll do my best here. So what is a financial crisis? First, they talk about financial frictions, which is essentially any barrier to savers and borrowers and households and firms to exchange funds and credit. So if you can imagine, in the worst possible case, there are no banks, so you can't invest, you can't keep your money anywhere, you can't get a mortgage, you can't get a loan for a car. Obviously, this would be terrible. And a financial crisis is essentially when those markets don't function. And the major theme here is what we already talked about a little bit, which is asymmetric information and the moral hazard that can go along with that. So the dynamics of a financial crisis. They talk about an initial phase, and then a banking crisis, and then debt deflation, where the initial phase has three parts, which is a credit boom and bust, asset price boom and bust, and an increase in uncertainty. So again, here I'm going to do my best to explain the 2008 housing crisis, because this should give you an idea of what this stuff means. So they talk about something called financial innovation, which sounds like a good thing, and I think can be a good thing, but can also be a very terrible thing. So the basic idea of the housing crisis and how it happened is first, of course, banks lend for home purchases called mortgages. You want to buy a house, you don't have the money right now, you take out a mortgage, and of course you pay an interest rate back. So that's how the bank would make money on that. Obviously that's been happening for decades and is not unique to the financial crisis. But leading up in the early 2000s, leading up to it, the banks essentially came up with this financial innovation, this new idea that where investors can buy these what they call these mortgage-backed securities. So essentially, a bank has enough, like an investment bank has enough capital that they can obviously issue thousands of these mortgages, where of course an individual couldn't do that. So they package them all up in one, and it's called a mortgage-backed security. So the idea is if you are an investor, you want to buy one of these, you are buying the rights to the payments on that mortgage. So of course, if the mortgage doesn't default and the homeowner keeps paying their monthly payment, you get the investor of this mortgage-backed security gets a return on that. So both individual and institutional owners can buy those. So again, it could be, for a 401k, just for your own personal investment portfolio, or it could be an institutional investor like another commercial or an investment bank. Or like I said before, 401ks like Fidelity, things like that. So after a while, this was making a lot of profit for the bank and for the investors. So the banks decided to lever up. So as I said, this really started right after the dot-com bubble, which was right after in the early 2000s, where I think it was Alan Greenspan at the time, the Fed chairman, decided to make interest rates really, really low. So this makes what they call credit cheap. So this makes it easy to borrow. So because of that, the banks could borrow for very, very cheap. So instead of just using their own capital to do this, they could do make up to 10 times the amount if they take on a lot of debt, and then with that money, they issue more mortgages. So they do that. And also, in the process of these mortgage-backed securities, they unload the risk on the investors. So, of course, if I am the bank, I make this mortgage and I sell it to you for a fee, I get that fee from you, but now the risk of that mortgage defaulting is no longer on me or the bank. So, of course, this incentivizes risk-taking to dramatically increase because in theory, it should not affect the bank if the mortgages default. So that is what is called subprime mortgages. So essentially they started, the lending practices deteriorated. If you've ever heard of like balloon loans, they would offer loans that the home buyers didn't really understand, where they would get a very, very low payment or low interest rate to begin with, but then it would balloon up in years to come. So their monthly payment may triple in the next coming years. And also just essentially people who they knew had a high chance of default, they would still give them a mortgage. So these are all called subprime mortgages. So in addition to that, they made something called, and again, this is a quote-unquote financial innovation. They created something called a CDO, or a collateralized debt obligation. So essentially, they packaged all of these individual mortgages and also with the subprime mortgages all into one big box, if you want to look at it that way. And that is what a CDO is. So the way that they sold this to the investors is there's a bunch of high-risk credit, mixed in with some of the good mortgages, and this becomes diversified to low risk. So the ratings agencies like Moody's ended up rating all of these CDOs AAA, which is essentially almost no chance of default. So this is our first example of asymmetric information or moral hazard. So underlying all of this is the fact that the banks who issue these mortgages know that they are very, very risky, but both the investors and the ratings agencies do not know that. So that is asymmetric information, and it becomes moral hazard because the banks are profiting from this. So in addition to this, another financial innovation was made by insurance companies, because they saw all this going on and they essentially wanted to get in on these profits. So they developed something called a CDS, or a credit default swap. So the idea here is, if you are an investor and you buy a mortgage-backed security or a CDO, and you want to insure yourself in a similar way that you maybe want to insure your house if it burns down, you don't want to lose everything, you pay a fraction of what the CDO is worth to buy a CDS, or a credit default swap. Meaning, if these mortgages do fail, or they are unable to make their payments, then you have downside, you have limited risk to that. So you get essentially an insurance payout if that happens. So the problem here was that certain firms, namely AIG, which I'll talk about here in a minute, were able to have multiple of these credit default swaps on one singular property. So there could be, sometimes up to 10. So meaning that the price of one house, if that was unable to get paid, they might have to pay out 10 times that amount. And of course, they ended up issuing so many of these that if they all failed, it would be orders of magnitude more than what their assets were worth. So they literally could not pay out all of these insurance claims on the CDOs if they all failed. And during that time, the credit insured went to $900 billion, which is 0.9 trillion, to $62 trillion, which is of course huge. So AIG during this process also actually bought CDOs themselves. So on one hand, they were obviously they were insuring them, and they were also buying them. So obviously they're taking a huge risk there if they fail. Not only do they have to pay out all of these insurance claims that they can't pay, they also have all of these of their own investments that end up being worthless. So the credit boom and bust A here, that would be initially in the early 2000s, it was easy credit, it was cheap money. So credit boom, which can be a good thing. That means people are lending, people are saving, people are investing. But of course, then it can end up with a subsequent bust. And the same thing with these asset price. It's the same idea, except if you can think of that would be just like the housing prices, that would be the asset price boom and bust. So, of course, as you all know, the idea behind all of this was that real estate or mortgage prices throughout history have only gone up. They've never gone down. But of course, they go down sharply in around 2007, 2008. And many of these mortgages, because a lot of them were subprime, and they knew they were essentially not going to be able to pay them, many lenders defaulted, which rendered the CDOs completely worthless. And like I said, the sellers of the credit default swaps could not pay them back. And the incentive for them to do that was so great because it was essentially free money in their eyes, because it's, insurance in general is whoever's buying it, it's something you pay for that you hope never happens. So if the price never goes down, which is what AIG thought, it's free money to them. These buyers of the CDSs are just giving them money for something that they'll never have to do in their eyes. But of course, that wasn't the case. So during that time, Lehman Brothers was also another big institutional investor in these CDOs. So they go bankrupt, and then, of course, that is part of this credit bust. So of course, if all banks did this, as I began this video with, we would be in big trouble, and nobody could lend, nobody could borrow. And the entire, that's what they call a financial crisis. That's where the entire financial institutions just essentially stop working. So that is why the government deemed AIG too big to fail, because they had too many ties throughout the world, and that's why this was felt throughout the world, because of course they had a ton of other insurance policies on many other things, including houses, cars, life insurance, things like that. So of course, if they went bankrupt and were unable to pay their CDSs, then they can't pay any of those other things either. So in addition to that, of course, everybody panics. And this is the piece of the banking crisis. This would be when people lose trust. And again, this is a part of this asymmetric information. They don't trust the banks. They don't know what they know. They know they have been deceived. So what they call a run on a bank was where people essentially want to go get their money and pull it out of the bank. And again, this just exacerbates the problem of decreasing credit. If the banks don't have any money from deposits, or people who deposit their money in the bank, then they don't have any money to lend. So that leads to no borrowing, no lending, and again, the financial markets stop working. Obviously, this is an extremely complicated thing. Again, I am no expert on the housing crisis. This is just how I understand it. There are some good videos on YouTube if you want to learn more. I think it's very interesting. You can just simply type in, how did the 2008 housing crisis happen? And I would also recommend a movie called The Big Short, if you all have not seen it. That's also an entertaining movie, but also gives you more insight into exactly how this happened. So that's it for Chapter 8. Again, I'm not going to go over all these terms and just read them to you all, but I would know those. And for the exam, of course, it's going to be open book, open note. I can't stop you all from doing that, but compared to the quizzes, there will be a less of a time limit per question. So you probably won't have as much time if you don't study at all, to go look up the definitions. So I recommend you do study a little bit, because there will be a bit more of a time crunch. So again, if anybody has questions, please email me. And I hope you all have been doing well on your other midterms.